So in option selling, generally how people come, they try a lot of things and then they come to option selling. That's how most of the people used to come. They try cash market, future option, buy option selling, they come. Okay, so once they come to option selling, what they generally do, they sell a naked options.
Right.
Okay, they sell a call and they sell a put. And for the retail people, option selling is equal to short strangle, nothing else. Okay, and some people will do the short straddle, that's it. So they think that actually option selling is nothing but a short strangle, and short strangle will have the highest pop. A pop is nothing but probability of profit is going to be very high, and they get a confidence. Anything you do for 1 month of time, you get a great confidence. So that's how, because if the market is less volatile, or if market is going to be range bound, even it is a trending market, if it is slightly up, slightly down, you are going to make a profit in short strangle.
Right. Okay, just holding you, because I'm going to keep on asking you question in the middle also. Can you please explain strangle for our use?
So strangle is nothing but you are going to sell out of the money call option and out of the money put option.
Okay.
And most of the time, say for example in Nifty, if you sell options 500 points away from the spot, say for example Nifty is going to be 11,000 and 11,500 call you are selling, and then 10,500 put you are selling, and most of the time you are going to be right. So out of 12 months, actually 10 months you are going to be right. And but one or 2 months actually it is going to be trending. That's how you are going to make a loss. Okay, but people will not look at that. Actually, people will look at the quick result. And when you look at the quick result, actually for 1 or 2 months, actually if you are making profit, they think that they are really talented. That is why actually I used to tell the trader, if option buyer or a future players are making a profit, they can always raise the collar. And if option seller is making a profit, you are not supposed to raise the collar, because you are not making profit out of the trend, or you are not making out of profit out of any view. You are making profit out of the time decay. It's a natural process. Okay. But if option buyer or future players are making profit, it is because of their talent. Okay. And anyway, actually if you make a profit, you feel that actually it is a talent. And then actually one day actually you will have a hit. So one of the first reason you need to understand in option selling is actually, and big boys never sell a naked options. Big boys never do a short strangle. And I'm going to ask the question to the retail people. If you are having 100 crores, will you sell put option for 50 crores and 50 crores call option? You will never do it, right? So, but when you have a 10 lakhs and 20 lakhs, you do that. So the first thing you need to stop the unlimited losses actually. First, never ever do the naked selling.
Right. So if you are not doing naked selling, then can I presume that means you are doing ratio trading?
No, it is not a ratio trading. Ratio trading is also naked selling.
Okay.
Because say for example, you buy one option and you sell 4 options, still 3 options are naked. So I mean ratio spread is not a naked selling.
Okay. So how do you define a strategy which is not a naked selling in options?
For every sell, you need to have a buy.
Oh, okay. So it has to be 1:1 then.
Correct, 1:1.
Okay. So when you say that ratio, it should not be more than 1:1. I mean, you can't do 1:2, 1:3 because your net exposure still remains there in the market. The moment you do 1:1, you are to a certain extent hedged in the market, right? Can you please explain with an example?
Say for example, actually, Nifty is 11,000 and then 10,500 you can sell, and 10,200 or 10,100 you can buy.
Oh, okay. So you are actually buying out of the money option and selling in the money option. That's interesting.
And selling option is for business and buying option is for insurance.
Oh, and you are ready to pay a small premium because you are buying out of the money options. So you are ready to pay a small premium as an insurance. If anything which is extraordinary happening in the market, you are at least protected with that extraordinary. But typically I have seen the retail investors, when market goes in their favor, the option which they have bought, typically they sell it off at a profit, and the options which they have sold, they retain that sell position because they feel that now I have made money, so I can take that risk of selling the option. Do you think it's a good strategy?
No, I don't think so.
So when you execute these kind of trades, both have to be squared simultaneously? Yeah,
when you enter also you need to enter the same time, when you exit also you need to exit the same time.
Right. So I can just take an example, the market today is say 11,000 and market based on the analysis, and I'm going to get into that how do you do that analysis, what will happen to the market, because the first thing required is to make an assessment of where the market is going. But let's say example that market is going to go to 12,000, that's my analysis. Now how do I play with an option with that?
You need to sell put.
I need to sell put. Okay. So you will always look out for a sell opportunity. You will not buy call?
I will never do that.
Okay. So typically you will sell 11,000 put or 10,500?
It's based on the premium.
Okay. And each strike price has unique premium?
Yes.
Because every strike price has a unique implied volatility, so that's why the premium is unique. You want to just quickly touch on to this, that why premiums is different for different strike price?
It has to be right. So because actually the distance is matters actually based on the volatility, and based on the expectation, the premium will be different for each strike price.
Right.
And how much danger it is. Say for example, the option which is very near to the spot is highly dangerous, will have the higher premium.
Right.
The option which is far OTM will have a less, vulnerable to the movement, so it will have the lowest premium.
Right.
So we need to choose the appropriate premium and sell options.
But how do you define that appropriate premium? Is it something which comes from experience, or is there any cheat sheet for that?
Actually, it came from experience, but when I analyzed myself actually, how I am looking at the premium, this is how I look, my internal feeling, okay, I analyzed myself, what I found, and say for example, in high weeks, you will get a better premium in for OTM. In low weeks, actually, you will get a premium only near to the spot. Okay. So I always concentrate on the premium. This premium I choose based on the return expectation. Based on the ROI on the margin.
Okay. Okay.
Say for example, Nifty, if the margin block is 1 lakh rupees,
right,
and your return expectation is 2%.
Right.
So wherever you get 2% return, actually go and sell it.
Oh, that's an interesting formula. Yeah.
Because actually, sometimes back actually I was having a formula of 25 rupees, 50 rupees. So for Bank Nifty I had 50 rupees. Right now I moved to 70 rupees. Because it based on the return expectation out of that strike price.
Just want to clarify this point, friends. It's a very important and very unique perspective he's giving. Typically, we always look at the quantum of option premium which we are investing or which we are getting. What he is adding to the perspective is that he's saying that look at the margin requirement for that underlying and see the price of the premium and see whether it is giving you that kind of a return on capital which you have deployed, and accordingly you participate in that premium. That's a very interesting perspective, right?